Today's preparation is about depreciation and book value. So expenses that a company incurs reduce their profits, and profits are taxed, and companies want to account for their expenses to reduce their taxes as much as possible. But tax regulations don't permit all assets to be completely expensed in the year that they're purchased. Specifically, if those assets are going to be used for more than a year, you typically can't treat that asset's cost as an expense, all of it, in that year, because your reduction in tax liability would be too big. Uncle Sam wants money. So enter depreciation. It is an artificial expense that spreads the purchase price of an asset over time for tax and accounting purposes. It's not that you actually pay for your asset with a 10-year plan or a 5-year plan, like get a loan to do that. It has nothing to do with actual cash flows. It has to do with for the purpose of preparing your tax return, and when a company is claiming something as expenses in order to reduce their tax liability, they can't claim it all at once. They need to spread it out over time. So there's a few methods that have been in use over the years, and the FE exam tests on two of them mostly. And the first of those is straight line depreciation. So with the straight line depreciation method, depreciation amount is the same each year. It's like we'll talk about book value soon, but it's the value, you can say, it's the same amount of value every year. And so you kind of get to charge the loss in value as an expense, right? If you buy something, yeah, you paid money for it, but it's valuable to you, right? You could sell it for just as much. So it's not necessarily an expense. It makes some sense that you're not allowed to treat everything as an expense, because it's still worth something, even if it's not money in your pocket. So, but you can assume that due to wear and tear, the life is finite, and so we assume it'll loses a certain amount of value every year, and under the straight line method, the depreciation amount is going to be the same each year. It loses the same amount of value each year. And so a company can treat that as expenses, and here is the equation to calculate the expense that they can charge. So DJ is the depreciation amount in year J, the expense that they get to claim on their tax returns. This here up top is called the depreciation basis. And the bottom is the depreciation or recovery period. So it makes some sense that the depreciation amount you get to charge is some basis divided by some amount of money divided by the number of years. Now, what's that amount of money? It would make some sense for it to be related to the cost that you paid for it. And so indeed, the C here is the purchase cost, and on the right side is the salvage value. So you only get to charge as an expense a fraction of the difference between the purchase cost and what you're going to salvage it for after the end of your depreciation period. And the amount's the same every year. So for most property, the IRS hasn't allowed the straight line method since 1981. Other methods have been used, but it is still used for intangible property. Stuff like patents can be depreciated using the straight line method. But the FE exam tests on it, so we're going to learn how to do these sorts of problems. So for example, a machine has an initial cost of $50,000, and we'll pretend that we can do the depreciation with the straight line method. The salvage value is $10,000 after a recovery period of 10 years. You're going to be able to sell it after 10 years for $10,000, so it hasn't lost all of its value. You're not going to be able to claim all of that amount as an expense in year one, nor are you going to be able to claim after 10 years will you have been able to claim the full purchase cost of the item, because it's still worth something. It still has a salvage value. The depreciation basis is not the full purchase cost. What's the straight line depreciation amount per year? All right, so we can determine the depreciation amount according to the straight line equation. So here's our problem. The depreciation amount dj is calculated according to the formula. So let's call this A. This will be B and C. We haven't gotten to those yet. dj is equal to C minus Sn over n, where C is the price that you paid for it. This here is the salvage value in year n, and this here is the number of years. And this top term is called the depreciation basis. So in our case here, that is 50,000 minus salvage value after 10 years is 10,000, and the number of years that we're talking about is 10. So it's 40,000 over 10 is $4,000. $4,000 is the depreciation amount per year. By the way, the subscript J refers to the in-year J. It just happens that the depreciation amount is the same every year. So D1, D2, D3, D4, they're all going to be the same with the straight line method. That's not true for other depreciation methods. Book value. So book value is the purchase price minus the accumulated depreciation. So think for a second. Can you figure out what the formula is going to be? It's the purchase price minus the accumulated depreciation. The depreciation amount in year J is D sub J. And so here's the formula for it. The book value in year T, and T is the year at the end of which you're looking for the book value, is C, the purchase cost, minus the sum of the accumulated depreciation, dj, from year 1 up to year t. The dj is the depreciation year j, and this sum is how much it accumulates from year 1 to year t. This here is a corrected version of equation 52.4 in your book. The book erroneously puts a subscript j there, and that's not quite right. Okay, next question. A machine has an initial cost of $50,000, same thing. But we're asking now, using the straight line depreciation method, what's the book value after 5 years? So let's switch over. What's the book value after 5 years? The book value, the symbol for that is, so this is part A. This here is B. The book value after 5 years, well, I'll just put T initially, and I'll substitute. Book value after T years is C minus, which is the initial purchase price, minus J equals 1 to number of years of the depreciation amount in year J. And it's going to be the same every year for the straight line method. So the book value after 5 years is the initial purchase price minus the sum from J equals 1 up through 5 years of our dj. Now our C is the initial cost, and dj we calculated according to this formula here, $4,000 per year. So it's going to be 50,000 minus, well, if this is the same amount each year and j goes from 1 to 5, then it's going to be minus 4,000 again 5 times. So minus 5 times 4,000. And that is equal to $30,000. $30,000 is the book value after 5 years, assuming straight line depreciation. So after 1981, new systems were put in place. So ACRS is the Accelerated Cost Recovery System that was introduced into 1981, and MACRS is the modified ACRS, and that was put into place into 1986's tax code. And the purpose of this is, if you have straight line depreciation, you're going to depreciate by a constant amount each year. Now, companies would prefer that they get to expense all of that up front, right? That's what the companies want, and the IRS wants, and the reason they want that is because they can claim all that as an expense, reduce their profits, reduce their tax liability, less paid taxes up front. Because of the time value of money, you don't want to pay taxes now. The IRS, on the other hand, wants that money because it's more valuable now than it will be several years down the line. So one compromise is depreciation, the straight line method. But to sway things, I guess, towards the side in favor of what the companies need, there is these accelerated cost recovery systems in which there's more depreciation upfront at the beginning. So these are calculated where DJ, the depreciation amount in year J, is just C, the initial amount. The depreciation basis hasn't been reduced by salvage value in this case. We're going to take the purchase price of the item and we're going to multiply it by a factor. You can think, for the straight line method, it was kind of like this factor was 1 over n, and instead of C, it was C minus the salvage value times 1 over n, or dividing by n. But in this MACRS system or ACRS system, you don't modify it with the salvage value. It doesn't take that into account. The depreciation basis is the purchase price of the item, and you multiply by a factor. The factor isn't 1 over n. Where does it come from? It comes from a table. And here's what the table looks like directly from the IRS publication, P946. I think this was from last year's, and I don't think they've changed this year, at least not substantially. And you do not need to memorize these values. If you get a question like this on the FE exam, or if I gave it to you on an exam, you would be able to look it up. It's probably going to be in the FE exam handbook. And so, you might notice these, you have to choose between 3, 5, 7, and 10 years over which you depreciate. According to the straight line method, I think that you kind of got to choose what is the end of the economic life, when are you planning on retiring the asset, and you get to choose the end. But now, according to the IRS publication, it specifies that different types of property are placed into different categories. 3-year depreciation rate, 5-year, 7-year, 10-year, etc., depending on what the item is. So you might notice that this 3-year item doesn't depreciate completely by the end of 3 years. 33% plus 44% plus 14.81%. Those do not sum up 100%. You've still got 7.41% of the original purchase price left to be depreciated in year 4. And that's because we use the half-year convention. You assume that the item was put into service and started depreciating halfway through the year, and it doesn't finish until halfway through the end of year 4. So that is why there is some, even though it's a 3-year depreciation, it appears to occur over years 1, 2, 3, and 4, because it actually occurs halfway through the year. Why they didn't just follow the year-end convention, I'm not sure, but that's the way it is. So let's do a last example. The machine has a cost of $50,000. Okay, what is the book value after 5 years using MACRS depreciation? So the book value after 5 years using MACRS is, well, the book value T is C minus the sum from J equals 1 to N of DJ, but DJ under MACRS is the initial purchase price, C, 50,000, multiplied by a factor, and that factor comes from a table. So the factors, I think I've got them here for years 1 through 5. So the factor for year 1, 2, 3, 4, and 5, when we're using a 10-year MACRS, if you look at the table on the previous page, in the first year it depreciates 10%. It depreciates 18%, so that's between when it's put into service. We say it starts depreciating halfway through the first year, and by the end of the year it's depreciated 10%. That's why in the next year, over the course of the full next year, it depreciates 18%. The year after that, it depreciates 14.4%. The year after that, it depreciates 11.52%. Where these numbers come from, I don't know, but they come from a table. They're in the tax code. And finally, in year 5, 9.22%. So it looks like it's small and getting big, but this is only for half a year. This is for a full year. Okay, so if all of these, well, I guess we have the book value then. Book value after 5 years is the 50,000 minus this C, the sum from, here, I guess I'll do this, C, J equals 1 to 5 of C, but that's 50,000 again, so we can say 50,000 times the factor for the year. And so that simplifies a little bit. It's 50,000 times 1 minus the sum from J equals 1 through 5 of the factors from years 1 through 5. So we just sum all these up, and the sum is, well, we get 1 minus the sum, which is 63.14%, and 1 minus that is 36.86%. 36.86% of 50,000 is 18,430 is the book value after 5 years.